Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Tuesday, May 19th, 2026. Stocks slipped again. The tone, cautious. Risk off, but not chaotic. The simple driver today was rising treasury yields, and the market immediately took that out on growth valuations. The headline indices looked ugly, mostly because the biggest megacap generals leaned red, even while the defensive parts of the market quietly held up. Look at the S&P 500 heat map. It was a total split screen. The growth-heavy tiles, especially communication services and consumer discretionary, deep red. But the defensive blocks really stood out. Healthcare and utilities, bright green and concentrated. That's the nuance today. Megacap weakness visually masked better defensive breadth. Even in semiconductors you saw a split, some names flashing green, while the broader complex stayed under pressure. Following that heat map, the money flow was pretty direct. Capital hid in defensives, healthcare, utilities, and staples, while traders de-risked crowded growth exposure as yields pushed higher. Energy also caught a bid, right alongside the inflation and oil narrative. On the flip side, communication services and discretionary took the brunt, and small caps felt it the most. Higher yields, tighter conditions, zero appetite for beta. So, what was the real tension holding the tape together? Yields versus stretched growth multiples. Traders treated a lot of tech bounces as sellable until yields cooled down, and importantly, it didn't feel like capitulation. It was more like deliberate rebalancing and risk budget reduction. Defensives helped limit the damage, but the market's message was crystal clear. No real bid for beta while rates keep leaning against it. On the chatter front, there wasn't a specific verified list of market rumors driving the session. The bigger narrative was positioning sensitivity to yields. But one headline thread did hit sentiment in AI infrastructure. News flow around a $5 billion AI cloud joint venture involving Blackstone and Google. That raised competitive concerns for some providers. But to be clear, the market impact here is about how traders interpret the headline, not a confirmed, earnings-type catalyst. Microsoft was down just under 1.5%. This is the kind of tape where higher yields translate into growth derating, and Microsoft is one of those core, mega-cap generals. When a name like this trades heavy, it's tough for the broader index to find lift, even if defensives are green underneath. Nvidia slipped just under 1%. Not a huge move on its own, but it mattered. Why? Because the AI complex is still trading like a duration-sensitive trade. With rates pressing higher, Nvidia stayed a pressure point. And as it goes, the whole AI ecosystem tends to read risk tighter. Alphabet dropped over 2%. This name helped define the heat map message that communication services was a weak link today. In a de-risking session tied to valuation sensitivity, that kind of mega-cap selling doesn't just hit one ticker, it pulls on sentiment across the entire growth complex. Amazon was down about 2%. It sat right in the crosshairs of today's tape, consumer discretionary plus growth sensitivity in a higher yield, risk-off session. Moves like this? They're a clean tell that growth was the funding source for the rotation into safety. Apple actually finished up about 0.5%. Right in the middle of broad megacap selling, Apple acted more like a quality hideout inside tech. That relative strength mattered. If even Apple had broken, the tape could have looked and felt a whole lot worse. Exxon rose over 1%, helping keep energy among the leaders. The analysis tied that strength to the inflation and oil narrative staying in focus. And look, when energy is green while the broader market is red, it often reads as a rotation toward real economy cash flows, especially on a day when growth multiples are getting squeezed. Looking ahead, the near-term setup stays pretty clean. The market focus? Ongoing treasury yield volatility, especially whether the 10-year stays near recent highs. Also, keep an eye on geopolitical and oil headlines, with the Iran and Strait of Hormuz narrative flagged as a volatility trigger. On the calendar next week, Tuesday, May 26th at 10 a.m. Eastern, we get CB consumer confidence. Then Thursday, May 28th brings core PCE, preliminary GDP jobless claims, and new home sales. No predictions here, just know those are the next big checkpoints for the rates narrative. Wrapping it up today looked like rotation, not a panic. Megacap growth pulled the indices down, while defensives quietly carried real leadership underneath. The takeaway into the next session is simple: watch yields. If they calm down, you can get a relief bid in growth, But if they keep pressing higher, the market's message stays exactly the same. Beta is still the easiest thing to sell. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.